Hi there, accountants. I hope all is well, and I pray that as you are viewing this video that you are in the best of health and spirit. In this video, we're going to cover Chapter 15, Leases. In Chapter 14, we learned about how companies, they account for their long-term debt, and we obviously discussed bonds, we discussed notes, and in this chapter, we're going to continue the discussion of debts and essentially how liabilities, sometimes they arise in connection to a lease, whereby let's think about it in personal terms. Somebody wants to get a new car, and instead of just purchasing the car outright or financing the car where they're going to own it at the end, sometimes they have the option to lease, whereby they'll utilize the car for maybe 1 year, 3 years, but the asset does not actually belong to them. This also applies in the business world, and we're going to learn a bit more about how businesses account for leases. So as it relates to leases, we have what's called the lessee and we have what's called the lessor. Another example in our practical everyday life is maybe you've leased an apartment, right? You don't actually own the house, or you don't own the space. You are just being given the privilege, the right to use the asset. So here we have the lessor. This is essentially the individual who owns the asset, whatever it is, whether it is the vehicle, the apartment, etc. And the lessor, the owner, gives the lessee, the user, the right to use the asset in exchange for the lessee making periodic cash payments every month and things of that nature. So that's the key thing to keep in mind. The lessor owns the asset and provides the right to use that asset for a specified period of time. So as we mentioned with the car leases, they could be 3 years, 5 years, whatever it is that is decided upon by the lessor, the owner, and the lessee, the user. Same thing as it relates to an apartment, right? For the most part, leases for an apartment are renewed every year or every few years. So there's a specified period, and the lessee, they receive the right to use the asset, and in exchange, they make periodic cash payments. So just keep that in mind. Now, why lease? Right? For some people, we live in this day and age where they're like, I want to own everything, but there are some advantages of leasing an asset rather than just purchasing it outright. So some of those advantages include lower upfront cost, cash requirements. So generally there's no fees or closing costs. Some companies, newer ones, they might not have enough cash to pay the full price for the asset, right? So if we think about, essentially, we'll go back to the personal experience. An individual, they need a car, but they don't necessarily have the money to, finance it. And leasing provides a cheaper option. Sometimes I see ads and they'll say $169 a month to lease a car, right? So in such case, that's in comparison to if you're financing it and you'll be paying maybe sometimes $300-400 a month for the same car. So that's one of the greatest advantages with a lease. There's lower upfront cash requirements. It also provides a great level of flexibility. So lease agreements, they can be easily tailored to whatever the lessee's specific needs are. So for example, sometimes companies, they might lease an asset for a short period of time based on the economic life of the asset or anywhere in between. So this flexibility, sometimes it can result in lower payments in comparison to if the asset was actually purchased. Then we have protection against declining asset values. So one thing we know for sure is that whenever the company buys an asset and it's being used up, it essentially loses value. Like they often say, when you purchase a car, as soon as you drive it off the lot, its value declines. So in such case, by the company leasing the asset, they don't need to worry about that, because if they purchase the asset, then at the end of its useful life, then they need to figure out how to potentially resell it. But once you lease the asset, you don't need to worry about that. Next, we have some tax advantages. So as it relates to tax advantages, some companies, especially those that are startup companies, sometimes they'll experience economic downturns, right? Things happen in the economy, right? You start a business and you might have a great idea, but maybe you don't have a great accounting system in place, or maybe you didn't necessarily project. Like a great example of not being forward thinking would be Blockbuster, right? Blockbuster, for those of you that ever used Blockbuster, was a place where you can go, you can rent movies. They used to have cassettes, the VHS, and then DVDs would started to come out. But then Netflix, came on the scene, and Netflix, they started streaming. So if Blockbuster were forward thinking, in such case, they would have started a streaming service, and we probably wouldn't even have Netflix today. But again, sometimes that was just an example of an economic downturn, or sometimes some companies, they can be in low tax brackets and they incur tax benefits through leasing. So these are obviously, just some of the advantages, but as we know, there are pros and cons with everything, but we just wanted to focus in on some of the benefits of why companies lease. So lease classification. So there's a specific way in which we account for leases. So for accounting purposes, we classify leases as follows, and it depends. Are we referring to the lessee or are we referring to the lessor? So the way we account for the lease, it ultimately depends on the substance of the lease transaction, right? So there's a few questions we need to consider, a few questions we need to ask to determine, is it going to be a finance lease or is it going to be an operating lease for the lessee? For the lessor, is it going to be a sales type lease? And if it's a sales type lease, is it with a selling profit or is it without a selling profit? Or is it going to be an operating lease? So a few key things you need to consider is the lease effectively the purchase of an asset with debt financing? In such case, then it would essentially be considered like a financing lease, or is it like a real rental agreement whereby it is literally, if we think about it, as mentioned, the question is substance. Is it more so that, hey, you are going to be able to use this asset for 5 months and after that, that's it? Or is it that the company is going to use the asset for 5 months and at the end, maybe the ownership of the asset is going to be transferred to the lessee? So these are things that need to be considered. So when it comes to lease classification, professional judgment is definitely going to be needed in order to differentiate between the leases. So in essence, are the installment purchase sales and those that are not? So classifying lease, it reflects the basic accounting concept, and that's referred to as substance over form. So from an accounting perspective, legal ownership of the asset over the lease period, it doesn't necessarily make a difference, right? But one of the key things is what's the economic substance of the transaction? So essential questions, as it states here, does the lease agreement have the characteristic of a finance lease? So with a finance lease, it is essentially, sorry, I lost my train of thought. Okay, here we go. The finance lease is pretty much similar to an asset, right? So that's like, let's say an individual, or we'll use a corporation, they want to go and they need to purchase equipment. And in such case, if they're going to purchase the equipment, then it would essentially be considered a finance lease. It's similar rather to the purchase of an asset. Similarly, reason being is because normally it allows the lessee to have direct use of the asset, and then the lessee, they're basically using up majority of the useful life of the asset. So some leases, they don't fit neatly into either of the classifications, but classify the leases according to the best evidence that's available. So obviously, as we can see, there's a lot of thought process that goes into it. So management, the accounting team, is going to be important for them to really consider all of the facts and circumstances to determine whether or not it should be classified as a financing or an operating lease. So there's some criteria. So a lease is considered a finance lease, sales type lease from the lessor's perspective if it meets one or more of 5 criteria. So this is the key thing. If it meets one or more, with certain things, it needs to meet all requirements. But what it states here is that if it meets at least one of these, it's going to be a finance lease. So the first one is the agreement specifies that the ownership of the asset transfers to the lessee. So in such case, at the end of the lease agreement, so in such case, then it'll be treated as a finance lease. So our objective, again, the key thing we want to determine is it a finance lease or is it an operating lease? So our objective is ultimately to determine whether the lessor has, if they essentially sold the asset to the lessee. So if there's going to be a passing of the legal title, then obviously the lessee owns the asset, or they're going to end up owning the asset. 2, if the agreement contains a purchase option that the lessee is reasonably certain to exercise. So this is called a bargain purchase option. So this is like what I was mentioning earlier. In the agreement, they have 5 months to utilize the equipment, and then at the end, they have the option to purchase the equipment and take ownership. In such case, it will be considered a finance lease. The lease term is for the major part of the remaining economic life of the underlying asset. So this is also something to keep in mind. So let's say there's an asset and the asset is going to be useful for 5 years, and the company, they're using it, they're leasing it for 4 years, they've used up the majority of the useful life, the major part of the economic life of that asset. In such case, it'll be considered a finance lease. 4 states the present value of the total lease payments equals or exceeds substantially all of the fair value of the underlying asset. So this is also something to consider. So with this 4th criteria, it basically indicates that if the lease payments have a total value that represents substantially all of the asset's fair value, then in such case, it's going to be logical to essentially consider it equivalent to a sale of the asset. So in such case, it's considered a finance lease. And then the last criteria is the underlying asset is of such a specialized nature that it is expected to have no alternative use to the lessor at the end of the lease term. So with that being said, again, at the end of it, there's no alternative use. So therefore, that would also be considered a finance lease, indicating that the lessor intends a sale of ownership rights at the end of the lease, because how else are they going to use the asset? So here we have finance leases and installment notes. So again, key thing is in chapter 14, we learn about how to account for installment notes. And for the most part, because of that, now we have a greater understanding of how we're going to account for a finance lease. And finance leases, they're basically just agreements that have the outward form of a lease, but essentially they are installment purchases. So here we have this example. It says, the below journal entries, they compare the recording of an installment note. As mentioned, that's what we learned in chapter 14. And it states, notice that we debit an asset account and credit a liability, regardless of whether the machinery is acquired through financing with a notes payable or through a finance lease. So here we see the journal entry here. We have the installment note, the machinery worth $666,633, and we credit notes payable. And then if we were to finance it, instead of debiting machinery, we're debiting the right of a use asset, because we know an asset is anything of value that provides the company with a future value, and we have the access, we have the right to use the asset, and then we credit lease payable, right? So in nature, if we think to the basics of accounting, it's essentially the same journal entry. There's just a little bit of change in the facts and circumstances. The installment note, we credit notes payable and debit machinery. For a finance lease, we debit another asset account, which is the right of use asset, because we don't actually own it, and we credit lease payable. So whenever there's a periodic payment, the interest expense is going to accrue at the effective rate times whatever the outstanding balance is, and the balance of the liability is going to be reduced for whatever that difference is. So similar journal entry, the interest expense, how did we determine that? So we know that it's a semi-annual payment, and based on a previous fact pattern, the interest rate was 14%, and we know interest is stated on an annual basis. So semi-annual means twice a year. So therefore, 7% interest expense based on the outstanding balance is going to be $46,664. And in addition to that, we promise that each period we are going to pay $139,857. It's not going to change. What does change, however, is how much of the payment is allocated to the principal balance, as we see here. Only $93,193 is going to be allocated to the principal balance, and the rest of it, this $46,664, this amount is going to be allocated to interest. So the cash payments, the installment payments or lease payments, those stay the same. What does change is how much of that payment is going to be allocated to interest versus how much of it is going to be allocated to the principal amount. So this is just a continuation. And again, because lease payable balance declines with each payment, the amount of interest expense is also going to decrease each payment. So as we see here, for the 6 years, we start off with the outstanding balance of $666,633. And then as mentioned, the payment is always going to be the same, does not change at all. But what does change is the amount that is going to be allocated to interest versus the amount that is going to be allocated to the principal and decrease the balance. So now we have this example application of a classification criteria. So it states January 1st, 2027, Sans Serif Publishers, they leased printing equipment from First Lease Corp. First Lease Corp purchased the equipment from CompuDeck Corporation at a cost of $479,079. The lease agreement specifies that there's going to be 6 annual payments of $100,000 beginning January 1st, the beginning of the lease, and every December from 2027 through 2031. The 6-year lease term is going to end December 31st, 2032, and it is equal to the estimated useful life of the equipment. First Lease Corp routinely acquires electronic equipment for leases to other firms, and the interest rate in these financing arrangements is 10%. All right, so remember, we had that 5-part criteria, and we're going to use that to determine how the lease should be classified. So now we need to ask, does the agreement specify that ownership of the asset transfers to the lease? No. Does the agreement contain a purchase option that's reasonably certain to be exercised? Not possibly, but is it reasonably certain that it's going to be exercised? No. 3, is the lease term the major part of the expected economic life of the asset? So let's think about it. The asset is expected to last economically 6 years, and our lease term is 6 years. So in such case, yes, it's using up the major part of the expected economic life of the asset. Is the present value of the lease payments equal to or greater than substantially all of the value? How do we figure that out? 100,000, we get the present value of an annuity due of $1. And again, the payments are due at the end of the year. So we use annuity due. We base it on the number of periods and the interest rate. So the number of periods is 6 years. The interest rate is 10%. So based on that, we multiply the lease payments by the percentage, or the factor rather, that we determined from the present value of an annuity table, and the value is $479,079. So in such case, yes, the present value does equal to or greater than the fair value. And 5, is the asset such a specialized nature that it's expected to have no alternative use? No. So as mentioned, all of the criteria do not need to be met to be considered a financing lease. The key thing is that at least one criteria must be met, and if it does, then in such a case, it's considered a finance lease. And in this case, questions 3 or criteria 3 and 4 were met. Therefore, the lease will be classified as a financing lease. So it'll be considered a finance lease to the lessee and a sales type lease to the lessor. So here we have this example. A finance lease for the lessee and a sales type lease for the lessor, where there's no selling profit. So here we have January 1st, Sans Serif, they lease printing equipment from First Lease Corp. First Lease purchased the equipment from CompuDeck at a cost of $479,079. The lease agreement specifies 6 annual payments of $100,000. The first payment is January 1st, 2027, and every December 31st going forward. The 6-year lease term is going to end December 31st, 2032, and it is equal, obviously, to the estimated useful life of the equipment. First Lease Corp, they often acquire electronic equipment for lease, and the interest rate is going to be 10%. So the price that Sans Serif is going to pay for the right to control the use of the equipment is going to be equivalent to the present value of the lease payments. So at the beginning of the lease, our journal entry is going to be as follows. We debit the right of use asset, which represents the present value of the lease payments, and we credit lease payable, which represents the present value of the lease payments as well. So an asset and a liability are recorded by the lessee at the present value of the lease payments. So keep that in mind. Next, for the lessor, they are going to debit lease receivable because that represents the amount that they are expected to receive from issuing this lease. So they debit lease receivable for $479,079. And then we credit equipment, which is the lessor's cost, the carrying amount. So one key thing to keep in mind, if we look at this, the lessor's entries are the flip side or a mirror image of the lessee's entries. So the journal entries for lease payments are as follows. So the first lease payment that they're making January 1st, 2027, we're going to debit the lease payable because we are paying down our balance. So if we think about it, like a regular credit card, we are debiting the liability account to show the decrease. And then we credit cash. Why? Because we're paying with cash. We're not paying with peanuts, right? And we know that based on the accounting principles that a debit to a cash or any other kind of asset account is going to show an increase, and a credit to an asset account reduces the balance. So for the lessee, debit lease payable, credit cash, and for the lessor, they debit cash for the money they're receiving, and they credit the leased receivable. Now, keep in mind, when this lease first happened, they made the payment the same day. So therefore, there was no interest that accrued. But now we're moving on to the payment at the end of the year. So the first thing we need to do is determine, well, what's the interest expense? So we know one thing, that they are going to pay $100,000. That is not going to change. Sans Serif is going to pay $100,000 every year. First Lease Corp is going to receive $100,000 every year. So these are things to keep in mind. So now we factor in the interest expense. So we have 10%, which represents the annual interest rate. We multiply it by the present value of the equipment minus the payment. So in such case, we see that there's the difference between the lease payable and the interest expense, because again, the key thing to keep in mind is that of this $100,000 payment, a portion of it is going to be allocated to interest expense, and then a portion of it is going to be allocated to payments towards the principal. So same thing, right? If we look at it here, First Lease Corp, they're getting cash of $100,000. Then we have our interest revenue, which is the $37,908. And now the difference between the two represents the lease receivable difference. All right, and this is fairly similar. So we're using the effective rate based on the outstanding balance. And then now we look at what the amortization schedule would look like. So in this case, as we look at it, we see that we started off with a balance of $479,079. And then after the payments for the 6 years, again, payments don't change, but what does change is how much is going to be allocated to the interest expense and how much of those payments will be allocated to the principal balance. All right, and again, just a quick tip. So as mentioned, for that first payment, you pay the full amount in full, and the reason being is because no time has passed, therefore no interest has accrued. So just keep that in mind. And then here we see the calculation of essentially how we determine the amount. So the key thing to keep in mind is that every time we determine the effective interest, it is the original amount of the lease payable minus the amount of the payment that is going to be allocated towards the principal balance. So very important to keep in mind. So one thing we need to consider is that once we do receive the right to use an asset, the right of use asset provides an economic benefit to the lessee. So the lessee amortizes its right of use asset over the lease term. And the amortization process usually is going to be on a straight line basis and is going to result in an expense for the lessee. And now we look at sales types lease with a selling profit. So in some cases, the lessor, they're not necessarily like a financial intermediary, but they're a manufacturer or retailer, and they use leases as a means of selling their products. And in addition, sometimes the interest revenue that's earned over the lease, the lessor receives a selling profit on the sale of that asset. So the selling profit, it'll occur or it'll exist whenever the fair market value of the asset, and this is usually the present value of the lease payments or the selling price, whenever it exceeds the cost of carrying value of the asset sold. So The lessor is going to recognize a selling profit on the sale of the asset. And selling profit, as we know, or gross profit, it's the difference between the sales revenue and the cost of goods sold. And then the lessor also recognizes interest revenue over the lease of the term. And here we just have this quick example with Dell. So when there's a sale of any product, right? Gross profit, as just mentioned, is going to be the sales minus the cost of goods sold. So Dell Technologies, as we see in this example here, they sold some of their products using a sales type lease, and they disclosed it in their accounting policy in this annual report shared here. So very important, because the leases are classified incorrectly. There can be some hefty fines, penalties, and things of that nature. So definitely always want to safeguard yourself. So as it relates to the sales type lease with the selling profit, we have to consider both the lessor, and we also have to consider the lessee. So when there's a selling profit, all lessor entries other than the entry to record the selling product are the same as the entries for a sales type lease without a selling profit. Next, for the lessee, the individual that is here, let me see, the lessee's accounting is not affected by whether or not the lessor recognizes a profit. So remember, the lessor is the owner, and the lessee is the one that receives the right to use the asset in exchange for making payments. So the lessee's accounting is not affected by whether or not the lessor recognizes a profit. The entries made by the lessee, they are exactly the same, with or without a selling profit to the lessor. So we have this example, all right, same fact pattern. We're dealing with sans serif. They specify 6 annual payments of $100,000 beginning January 1st, 2027, 6-year lease term. And here it's now letting us know that CompUU manufactured the equipment at a cost of $300,000. So these are things for us to consider. So at the beginning of the lease, the journal entry would be as follows. We can even separate these journal entries, but it's all good. So in such case, we debit the lease receivable that is representative of the present value of the lease payments, and we credit sales revenue for $479,079. So now the other thing we need to consider is the cost of goods sold. We know the cost of goods sold is essentially the cost of however or whatever you are selling, right? So that's one thing I love about accounting. A lot of times the wording or the definition of the word is in the definition in and of itself, right? So just keep that in mind. So we debit the cost of goods sold, and then we credit the equipment because the equipment is an asset. And in order to take an asset account off of our books, we have to debit it, or to credit it rather. So here it states, because the present value of the lease payments of $479,079 higher than the cost of the product lease, which is $300,000, the lessor in such case, ultimately they have a profit of $179,079. And that is going to be recorded at the beginning of the lease. And then I guess as it relates to, you know, okay, here we are. Yep. So as it relates to essentially the lease payments, again, that is how much we promised we are going to pay to the lessor. It does not change. So in such case, we're going to debit the cash for the lessor because they're receiving $100,000 in cash, and then credit lease receivable because the amount that is owed to us has reduced because of the payment. And as it states here, the payment was made January 1st, 2027. So therefore, there's no interest that it has accrued when the first payment is made at the beginning of the year. So next we have a sales type lease with a selling profit. It is essentially a sale. So here it says, let's say you purchase a TV from Best Buy for $479, pay for it with your Best Buy credit card, and at the end, Best Buy paid the wholesale price of $300 to Samsung to acquire the TV. This is what our journal entries would be like. We would debit accounts receivable for $479, and then we'll credit sales revenue for $479. Because again, based on the logic of accounting principles, DCA LER, in order to increase the balance in any of the asset expense or dividend accounts, you must debit it. And any time to increase the balance for a credit account or for a liability, equity, which represents common stock, owner's investments, or revenue account, we must credit it. So all of those fundamentals tie right back in. And then this is us recording the sales amount. Then here we're recording the cost of goods sold. So debiting the cost of goods sold, which is an expense, and crediting the inventory asset account to reduce the balance in the equipment because we no longer have the equipment. So we have sales type lease versus other sales. And now we're going to compare these entries to the entry to record our sale by lease. So the lease receivable, debit, credit sales revenue, debit cost of goods sold, and credit the equipment. So you can put together a compound entry where all of the things are in one entry per the instructions, or you can feel free to just separate them as you see here. So next we move on to operating leases. So essentially, if a lease doesn't meet any of the 5 criteria for a finance/sales type lease, then it is going to be considered an operating lease. And whenever there's an operating lease, the lessor, they retain the risk, then they end the benefits of ownership, and the lessee pays for the right to use the asset temporarily. So think of this like renting a car, right? They are essentially leasing the asset to you. You rent the car for however long. At the end of the day, you come and you bring it back. So when it is truly like a rental in nature. So whenever they don't meet any of the criteria, so lessor, again, they're going to retain the risk and benefits. They're going to report lease revenue and an equal amount of payments each period. For a lessee, they're going to pay for the right to use the asset temporarily. They're going to report a right of use assets and a lease liability as it would with a finance lease. And then lastly, we're going to report equal amounts of lease expenses on the income statement each period. Here we have this illustration, same fact pattern, right? The equipment is $479,079. We're dealing with First Lease, who purchased the equipment for CompuDeck. And then we have Sans Serif. The annual interest rate is 10%, and the lease agreement specifies 4 annual payments of $100,000 between January 1st, 2027, and the beginning of the lease, and at the end of each December. And the useful life of the equipment is estimated to be 6 years. All right, so we have this illustration, and we see here the lease does not meet any of the criteria for the finance sales type lease, so it's going to be accounted for as an operating lease. So such here, we see we debit the right of use asset for $348,685, and then we're going to credit the lease payable for $348,685. All right, now we're going to factor in the first lease payment under an operating lease. So under the operating lease is fairly straightforward. So we credit cash because that's what we're paying. And from there, we debit the lease payable to reduce the balance of our liability. Next, we move on for the lessor. So for the lessor, they're getting this cash of $100,000, and they're going to credit their deferred lease revenue that is going to be considered earned in 2027. So it really all depends on the nature of, the agreement, whether or not it is going to be financing or operating leases we see. So here we see we're making the payment, the interest payment, and we know that the interest expense is going to be based on the carrying value of the equipment. So here we see for the lessee, we find our interest expense. And again, we want to determine of this $100,000 payment, how much is going to be allocated to the liability, and then how much of it is going to be allocated to the expense. And now for the lessor, they're going to record the January 1st lease payment. They're going to debit deferred lease $400,000, credit lease revenue. Cash, they're going to debit the cash and credit deferred lease revenue. And then lastly, we also factor in depreciation expense. So the cost, the present value is $479,079, and we divide it by 6 years. It's another thing to really keep in mind. sometimes it essentially lets you know that payments are made annually. So when it's annually, you just utilize the interest that was given. But whenever there are two periods or payments happen, frequently during a year in such case, it is very important to determine, because in the event that, let's say, the payments were made semi-annually, in such case, we would need to divide it by 12. But again, I want to make sure you understand that. So for the depreciation expense, the total cost based on the present value tables, and then we divide it by 6 years. So the depreciation expense will be $79,847. And this is just showing us the lease amortization is mentioned. You start off with your beginning balance, and then from there, you basically, work your way down. Every time you make the $100,000 payment, a portion of it is going to the interest, and then another portion of it is going to a decrease in balance. All right, so here we're covering operating lease interest and amortization. So here we see that the interest is $24,869, and then we factor in the amortization, and that is how we determine our lease expense. All right, and this is for the second lease payment that is going to be made. So next we have reporting lease expense and lease revenue. So after we record the entries, the lessee is going to have two lease related expenses. The first is going to be interest expense, and then the other is going to be amortization expense. However, the lessee is going to combine these two accounts into a single lease expense, and they're going to report a single $100,000 amount each year in the income statement. And in regard to the finance lease, the lessee is going to report interest expense and amortization expense separately in the income statement. The lessor has a single lease revenue account and an operating lease and reports that straight line amount. And the lessee, they're going to report lease expense on a straight line basis, and the lessor is going to report lease revenue on a straight line basis. So here we just have, an example of the operating lease and determining what the lease expense and the revenue are going to be. And this just kind of depicts the comparison of the lessee's expense recognition if we were working using a finance lease or if it were an operating lease. And as we can see, the key difference here is essentially going to be under the finance lease. And the key thing to see is that at the end of it, interest expense is going to be the same, amortization expense is going to be the same, and the total expense is going to be the same. However, what does change is how much is going to be treated as an amortization expense, whether we are using a financing lease or operating lease. So under the financing lease, we see it's, an even amount versus the amortization expense where it changes per year. So in an operating lease, it's the total lease expense, but not the amortization component. That's a straight line amount. So as we know, oftentimes there are some differences between US GAAP, generally accepted accounting principles, in comparison to IFRS, International Financing Reporting Standards. So under IFRS number 16, all leases are accounted for as financing leases by the lessee. There's what's called a one model approach. And only lessors apply the classification criteria to distinguish between finance and operating leases. Thus, even for leases that qualify under US GAAP under this two model approach as operating leases, the lessee is going to amortize the right of use asset on a straight line basis rather than plugging in the amount to determine how to finish up the journal entry. So as we can see, there are some differences between US GAAP and IFRS. So next we have to factor in the financial statement impact. So there's a lot of benefits, as we saw, to leasing assets. Nevertheless, when we're considering investors and creditors, there's something that needs to be considered because obviously, there's an impact on a company's financial position and risk. So a lot of times we saw a disclosure requirement before, and it needs to include in the disclosure the lease liabilities and operating lease liabilities separately. So financing leases are reported separately. operating lease liabilities are reported separately. So many lessees, they try to devise schemes to meet the criteria for operating leases because in such case, they'll get to reap the benefit of straight line expensing. And from the perspective of an analyst, sometimes it can be unclear why expenses associated with operating leases should be treated differently in comparison to expenses associated with finance leasings. And it is likely that some sophisticated users, they'll restate the financial statements to back out the straight line recognition afforded at operating leases and treat them like finance leases, similar to how they are treated under IFRS. So this is definitely something to keep in mind. There are, again, the impact on the financial statements ultimately. So next we factor in the discount rate. So one of the important things that we've seen it as we went through several journal entries, one of the key things is essentially going to be the discount rate. So the implicit rate is used to consider the time value of money while calculating the present value. So this is essentially the desired rate of return that the lessor has in mind when they're deciding the size of the lease payments. And when the lessor's implicit rate is unknown, then the lessee, they're going to have to use their own incremental borrowing rate. And that is the rate that the lessee would expect to pay a bank if the funds were borrowed to pay the asset. So these are something to keep in mind. And one thing to keep in mind, you might wonder, well, why are we using these charts? Why are we using these tables? So because lease payments, they occur in future periods, we need to consider the time value of money, evaluating their present value. So the rate is going to be important because it ultimately helps to influence the amounts that's going to be reported both by the lessee as well as the lessor. So they do have what's called a shortcut method. So sometimes it's not, unusual to help simplify accounting for situations in which doing so, if there's no material impact on the financial statements, if it changes it maybe just by, a couple dollars, then it's not considered material. So in such case, we have this shortcut method when it is a short-term lease. And this is where they have a lease term, including any options to renew or extend, or 12 months or less, and it does not contain a purchase option that the lessee is reasonably certain to exercise, which would extend the term beyond 12 months. Then in such case, the lessee can elect to not record an asset or lease liability, and instead they can record lease payments as rent expense over the lease term. So they can make it, easier for themselves, just record it as rent expense, cash going out, and that's that, right? But these two requirements need to be met. And this is also the approach used by the lessor for lease revenue on the flip side of the transaction. So that's the shortcut method. So we have a short-term lease example. Says January 1st, sans serif publishers leased printing equipment from First Lease. The lease agreement specifies 12 monthly payments of $8,333. The first payment is going to be made January 1st, 2027, beginning of the lease, and on the first day of each of the next 11 months. The useful life of the equipment is expected to be 6 years. All right, so we know first and foremost that they're not going to be leasing it for the majority of the economic useful life of the asset. They're going to be leasing it for 12 months, the equivalent to 1 year, and the estimated life is 6 years. So at the beginning of the lease, there's going to be no entry. We're not recording the right of use, asset, and liability. What does happen, however, is that the monthly lease payments, we're just going to debit lease expense and we're going to credit cash, and that's it. So again, this is going to be the shortcut method. All right, and this is just showing, an example or the differentiation rather between the international financial reporting standards and the shortcut method. So what do they say you have to do internationally versus what do they say needs to be done under US GAAP? So sometimes there are some similarities and sometimes there are some differences. So we see here, both US GAAP and IFRS allows the shortcut method for short-term leases. But as we see, US GAAP, though, they define a short-term lease as a lease that has a lease term of 12 months or less and doesn't include a purchase option that the lessee is reasonably certain to exercise. The IFRS, they preclude a lease from being considered short-term if the lease includes a purchase option, regardless of whether it is going to be exercised or not. So if there's a purchase option under IFRS, no, it cannot be accounted for under the shortcut method. And US GAAP, they don't allow the shortcut method for low value leases if it's $5,000 or less. And IFRS, they allow the low value leases 5,000 or less to apply to the shortcut method. So as we know, sometimes there are some similarities between generally accepted accounting principles in the US, and sometimes there are some differences between US GAAP and IFRS. So some things to keep in mind. What if the lease term is uncertain? So sometimes the actual term of a lease is not always obvious, right? So let's say, for example, that the lease term, they say it's going to be 3 years, right? But it can be renewed at the end for another 3 years. So in such case, the lease term, it's kind of sort of uncertain because maybe they'll keep it just for the 3 years and then extend, or maybe they won't. So these are some things to keep in mind. So the contractual lease term is adjusted for any renewal or termination options that are reasonably certain to be exercised after considering the relevant economic factors. And if the benefits are sufficiently high that we think that they are going to be exercised, so the company at the end of the lease terms, they're thinking, hey, you know what? They're going to extend it for another 3 years, based on the example that I use, then in such case, the contract term is going to be adjusted by adding the renewal period, or they can subtract the period that follows the termination option. So in such cases, sometimes you might have to reassess. So the lessee, they're going to have to reassess the lease term only when there's going to be a significant event or change in a circumstance. So something that triggers a change in the economic the lease or termination of the lease. So here we just have this quick example. We say, assume that a lessee has no significant economic incentive at the beginning of a 6-year lease. So they have an option to extend it for 2 years, but we don't know what's going to happen. But in the event, let's just say that by the end of the 3rd year, the lessee has made significant improvements to the asset, and the cost could be recovered only if they exercise the extension option. So in such case, the extension is going to be reasonably certain. It's more likely than not is going to happen. So in such case, the full term of the lease is now going to be expected to be a total of 8 years with the 5 years remaining. So originally it was a 6-year lease with a 2-year extension, which was optional. But because of recognizing it at the end of the 3rd year, now it has transitioned, for lack of a better word, to now an 8-year lease. And since they've already used up 3 years, then there's 5 years remaining. And at the end of the 3rd year, the lessee, they're going to remeasure the lease liability at the present value of the remaining 5 lease payments. All right, so as we continue on with this example, so the discount rate for the new term is going to be the incremental borrowing rate of the lessee using the market interest rates at the time of the reassessment. So that's one of the key things to keep in mind. So we assume in this case that the present value of the remaining 5 lease payments is going to total $400,000. And the current balance of the lease liability before we actually remeasure it is going to be $250,000. So in such case, we're going to need to make the following adjustments. So the present value of the 5 payments is $400,000. The liability after 3 years is $250,000. So therefore, there needs to be an increase in the balance of $150,000. So we now increase the value of the right of use asset, and we increase the value of the liability, the lease payable. So whenever there's going to be a change in lease terms, sometimes we might need to figure out, well, hey, is it still a financing lease, or is it now an operating lease, or vice versa? So whenever there's a change in the lease terms, lessees, they're also required to reassess the classification of the lease. So in the example that we essentially just saw, once the renewal is going to be assumed, then the lease term is for the entire useful life of the asset. So as remember, that was one of the requirements, one of the criteria. Is the lease going to represent the major part of the economic substantial life of the asset? And in such case, we saw before was 6 years. Now, because of this 2-year addition, it's going to be 8 years, which represents the entire useful life of the asset. So if the classification has changed, then lessee, they need to account for the lease as a finance lease for the remainder of the lease term. Lessors, they are not permitted to reassess the initial termination of the lease term or discount rate. So what we're discussing is only applies to the lessee, the user of the asset. Another thing we need to factor in is uncertainty of lease payments. So sometimes lease payments, they're scheduled to be increased or decreased at a future date during the lease term. And it depends on whether or not sometimes if certain things happen. So some examples may include, but not limited to, maybe there's a contingency regarding revenue. So if the company doesn't make, X, Y, Z in revenue, then in such case, then the payments might increase or decrease, profitability, the usage of the asset. So these are things that ultimately can have an impact on the amount of the lease payments that are going to be made. Maybe they'll increase, maybe they'll decrease. It really all depends on one of these triggering events or specified events and if they actually happen or not. So here we have this example. So uncertainty of lease payments. We have a recent annual report of GAAP. So you might ask yourself, why would a lease even have a contingent, right? So these are things that unfortunately, well, I wouldn't say unfortunately, but within the profession, these are things that do happen. So this is a way for lessees and lessors. They basically share the risk that's associated with the productivity of the asset. So for example, we look at GAAP and let's say they have a location and they're anticipating that they have higher revenue. In such case, if the retail center is going to, bring a new number of persons to come to this location to shop, then in such case, the lessor, they want a part of the higher profit. Okay, they want a piece of the pie. But if not, then the lessee is going to just make the normal payments. So this arrangement, it's also going to provide the lessor with incentives to make shoppers want to go to the mall, right? Want to go to the retail center, which is going to be in the lessee's best interest. So basically kind of like you scratch my back, I scratch your back in a sense, right? And it ultimately depends on the nature of the companies who you are leasing from. Some corporations, again, if your revenue starts to meet a certain amount, they'll want a bigger payment. If it reduces, then in such case, maybe they'll say, hey, you know what, you're not using this asset productively. In such case, maybe they'll reduce the payment, or maybe they'll say you can no longer use the asset, right? So sometimes there are contingencies that are detailed in leases. So the general accounting for uncertainty of payment options, because the amounts of contingent lease payments are uncertain and they're also avoidable, we don't consider them as part of the lease payments used to calculate the lessee's lease liability and the lessor's lease receivable. So if and when these payments increase, then the change in the lease payments, they're going to have no effect on the balance sheet accounts. It's just basically going to be reported as a separate lease expense for the lessee and as lease revenue for the lessor. There are two exceptions to not including variable payments in a calculation of the lease liability recorded at the beginning of the lease. So when there's variable lease payments are in substance fixed payments. So this first exception, again, is whenever the variable payments, they actually are in substance fixed payments. So in such case, they'll be included, and these fixed payments, they'll be considered in disguise as part of the lessee's lease payments. So that's something to keep in mind. And whenever the variable lease payments, they depend on an index or rate. So sometimes that's what it ultimately depends on. So sometimes it could depend on the consumer price index or current interest rates. But again, even though lease payments, they're going to vary in the future, you would use the initial lease payment amount based on the current index or rate in order to discount to the present value when determining the right of use asset, the lease liability, as well as the lease receivable. So just like any other variable lease payment, if and when the lease payments, they change in the future, then it'll be reported as additional amount, and it'll also be treated as separate lease payments. It'll be an expense for the lessee and revenue for the lessor. And this is just going over a quick example of how the reassessment of the right of use asset, how it's treated for US GAAP and how it is treated for IFRS. Under GAAP, only if the lease asset and lease liability are later remeasured for another reason will the change in payments based on the consumer price index or market interest rate affect the right of use asset. Under IFRS, a lessee is going to remeasure the variable lease payments that depend on an index or rate, not just when the lessee remeasures the right of use asset and lease liability for other reasons, but also whenever there's going to be a change in the cash flows that result from a change in the referenced index or rate. So again, some things for US GAAP are similar to IFRS, and some things are slightly different, or some things are extremely different. So next we move on to lease modification. So sometimes throughout the duration of the lease, sometimes there might be some changes. So in such case, there's two possibilities if the lease is modified. So the modification, it might grant the lessee with an additional right of use. And this would essentially mean that the original lease no longer in standing, and you are going to account for the modified arrangement as a brand new lease. Next, you have the modification agreement. It might alter the lessee's right to use the asset rather than grant additional right to use. So in such case, then they would have to adjust, they would add, or they would delete whatever has been recorded to conform to the new terms of the contract. And let's say that there's a change in a lease term or something like that. So these are things to keep in mind. And if it's necessary, we'll reclassify the lease from one type to another. And modifying lease terms, sometimes they require reclassifying operating leases to finance leases or vice versa. It can go from one to the other because, again, for a finance lease, there are those 5 criteria. And once someone meets at least one, it would be considered a finance lease in comparison to an operating lease, which is basically just like a rental agreement. So here we have a lease modification example. We have the same fact pattern. We have sans serif, January 1st, they purchased the asset. First Lease Corp, they purchased it for $479,079. We know that the borrowing rate is 10%. We know that the corporation, the company, agreed to make 4 annual payments of $100,000 starting on January 1st. Then we have the useful life of the equipment is estimated to be 6 years. The present value of the 4 payments, we found it. And then on January 1st, 2029, after 3 payments, the lessee and lessor, they agreed to 1, extend the lease term by 2 years, and 2, increase the remaining 3 payments from $100,000 to $130,000 each. And another thing we see is that the market rate of interest at the time, it decreased. It used to be 10%, and now it is 9%. So here we see the modification occurs 2 years into the lease, but there have been 3 payments since the payments are made at the beginning of each year. So something to keep in mind. And then here we just see the table is summarizing the effect of the 4 important contract modifications. So the term has changed from 4 years to 6 years. The payments have changed from $100,000 to $130,000. And from there, the classification change. It used to be an operating asset, but now with these modifications, it is a finance sales type lease. All right. And then next we have just, another depiction of the modification example and how the journal entries will be recorded. And now we have to factor in residual value. So with residual value, here we see it's an estimate of what a leased asset commercial will be at the end of the lease term. So let's say, we use the example with the car. We have a car and we purchased, let's just say $5,000 for the car. And now at the end of the car's life, we decided we're going to scrap it. So in that case that we scrap it, now, there's people that, what is it called? They scrap metal, they scrap the vehicle. And in such case, what they can essentially do is scrap it, and of the $5,000, maybe you'll get about $500 or a few $100s. I had a car once, and at the end of it, sometimes they have places where they have posters and they're like, we buy used cars, no matter the condition. So I was able to scrap it and received a few $100s. So that essentially is a practical example of the residual value of what you can potentially get for it. So residual value It affects several aspects of lease accounting, including the size of the periodic lease payments, the classification of the lease, as well as the amounts recorded by the lessee and the lessor. Next, we have guaranteed residual. So a residual value guarantee means that the lessee guarantees the residual value is going to be a specified amount when they return the lease asset at the end of the lease term. The lessee is going to promise to return not only the property, but possibly also sufficient cash to meet the guaranteed amount promised in the lease agreement. And this ultimately provides an incentive for the lessee to exercise a higher degree of care in maintaining the lease asset, because obviously they would want to preserve the residual value. So here we have this example, and it says, suppose the printing equipment leased in our finance/sales type lease, and the earlier problem is expected to be worth $60,000 at the end of the 6 years. So in such case, the leasing company, they purchased the equipment for $479,079. That is the amount that the company is going to need to recover through the leasing contract, along with any interest revenue sufficient to achieve their business objectives. So in such case, the amount to be recovered is going to be the $479,000. And from there, they divide it by the present value of an annuity due. And that is ultimately how they determine how much of the lease payments need to be made. But if the lessor, if they're going to get the asset back at the end of the lease and the asset has the value, then the lessor is going to have another source of return. The value of the asset itself, the residual value, is going to provide another source of recovery for the lessor. And then it's going to reduce the amount that's needed from the periodic lessee payments for the lessor in order to generate their 10% return. So here we have this example. Same, line of thought. We have Sans Serif Publishers. They lease printing equipment from First Lease Corp. First Lease, they purchased the equipment for $479,079. And saying, assume the lease includes 6 annual payments that begin January 1st, 2027, and each on December 31st, 2027. And at the end of the 6-year life, December 31st, 2022, the equipment is expected to have a residual value of $60,000, and the estimated useful life of the equipment is 7 years. So if the 6 lease payments are equal amount, what payment amount is going to provide First Lease Corp with a return of 10%? So this ultimately helps the company to determine, well, how much the lease payments actually need to be. So the amount to be recovered, which is the fair value, is the $479,000. Next, we factor in what's the present value of the residual value. So we are expecting it's going to be, a residual value of $60,000. We multiply it by the present value of $1. So here's the key thing. Why are we using present value of $1 and not an annuity? So the present value of $1 is just a single amount. We're getting this $60,000 once, and that's it. Annuity, that represents equal payments that are continually happening. So in such case, that is why we multiply the present value of the residual value by the present value of $1. And then from there, in order for us to determine how much our lease payments are going to be, we factor in the present value of an annuity due. Why? Again, because annuity represents equal payments that are going to be made. So here we see both the present value of the lease payments and the present value of the residual value. They're going to be combined to allow the lessor to recover their $479,079 investment, right? Because they First Lease Corp, they paid CompuDec, right? And they want to make sure they get their money back. So in such case, the present value of the lease payments and the present value of the residual is going to help them to recover that $479,079. And the lessor, they're going to include the residual value at the present value in their lease receivable, regardless of whether it's guaranteed or not, because they're expecting to receive that value either way. All right. So the lessor is like, I'm good either way, pretty much. So here's how they can record it. The lease receivable, present value of lease payments plus the $60,000, or the lessor could record the receivable in the residual account separately. So they could record the present value of the lease receivable and then the present value of the residual asset and then credit the equipment account. So they could make it all in one entry, the total value, or they can essentially make it a compound entry and break out the present value of the lease payments and the present value of the residual asset. All right, this is just an example of the amortization schedule and what it looks like again, so we know how much we're going to be paying each period. And then here we see that there's this 60,000 because that is how much they are expecting to receive. And then here we see that there's payments that are going to be made each year. And as we mentioned earlier, the only thing that changes is the decrease in balance versus the interest. So the allocation is essentially what is changed. And then at the end of the lease term, the lessor, they're going to record the following journal entry. So they're going to debit the equipment account because they now have the equipment back and it's worth 60,000. They're going to credit the lease receivable, and then they're going to credit the interest revenue for the outstanding balance. So as you can see, there's a lot that goes into recording leases. So with this journal entry, we have the lease receivable, and this is at the beginning of the lease. We debit lease receivable for the 479,000. We credit cost of goods sold. And then here's how we determine this. The lease receivable is the present value of the lease payments plus the $60,000 residual value. And then from there, we have to figure out our cost of goods sold. So we purchased it, a cost rather, to manufacture 300,000 minus the residual value that they are expecting to receive back, which is the 266,132. And then for the sales revenue, yeah, we are selling it for 479,000 and expecting the present value, the residual value of 33,868. So therefore, the difference represents the sales revenue. And then from there, we factor in the equipment, the lessor's cost, which is the $300,000. So there's a lot of moving pieces in this problem. But again, once you get a gist of essentially what needs to be accounted for, everything will come together full circle. So other than the reduction of lease payments, we also need to factor in, should the lessee, sans serif publishers, do they need to be concerned with the residual value of the leased asset, right? And we can't say no, we can't say yes. The answer is, maybe, depending on the situation. So we need to figure out, has the lessee, did they arrange a guarantee, a specific value of the residual value at the end of the lease? And then we're going to have to figure out, well, how does that value compare to the prediction of its actual value? So as we mentioned earlier, sometimes lease agreements, they can include a guarantee by the lessee that the lessor is going to recover a specific residual value whenever the lessee returns the assets at the end of the lease term. So the lessee, they're basically going to be promising, hey, I'm going to return the asset, and then I'm also going to allow, or provide rather, sufficient cash that you're going to get a combined value. But that doesn't necessarily mean that the lessee is going to actually make a cash payment. So sometimes it can be made, sometimes it doesn't have to. So in the event that a cash payment under a lease lessee guaranteed residual value is predicted, then the present value of the payment is going to be added to the amount that the lessee records as both a right of use asset as well as a lease liability. And the lessor is going to include in the expected cash payment as well as the residual value itself in the lease receivable. And this is assuming that it's a sales type lease for the lessor. And if the residual value, if it's not guaranteed by the lessee or is guaranteed by the lessee, but the guaranteed amount, if it doesn't differ from the estimate of the actual fair value at the end of the lease term, then it's not going to affect the lessee's calculation of the right of use asset or the lease liability. And other than, the only thing it does is it influences the amount of each lease payment. So something to keep in mind when there is a predicted cash payment to be made. So as we know, leases, they're classified as either finance lease or sales type lease, if in substance the lessor is transferring control of the asset to the lessee. So in such case, one of the classification criteria is there needs to be a comparison of the fair market value of the asset with the present value of the payments from the lessee. And then payments from the lessee, their periodic lease payments plus any portion of the residual value that the lessee has guaranteed. So next we have what's called purchase options. So a purchase option is a provision of some lease contracts, and it basically gives the lessee the option to purchase the lease asset during or at the end of the lease term at a specified exercise price. So this you'll see often with like cars, right? Especially when you lease a car at the end, they'll say, hey, you know what? Yeah, you paid, $25,000 for this car. You leased the car rather and paid, monthly payments of $200. At the end of the 3 years, I'll sell you the car for $10,000. Right? So the individual, the company, they have the option to determine whether or not they want to exercise that option or not. So if it is reasonably certain that the lessee is going to exercise the purchase option, the accounting for the lessee is going to be affected in 3 ways. The lease is going to be classified as a finance lease for a lessee, sales type lease for a lessor. And both the lessee and the lessor, they're going to consider the exercise price of the option to be considered an additional cash payment. And then you'll also assume that the lease term is going to end on the date that the option is expected to be exercised. And in practice, in the profession, purchase option whose exercise is reasonably certain to be exercised, that's referred to as a bargain purchase option, so a BPO. So here we have this quick example. Again, same fact pattern. We have sans serif. The agreement is going to be 6 payments of $92,931 on December 31st, 2032. At the end of the 6-year lease term, the equipment is expected to be worth $75,000, and sans serif has the option to purchase it for $60,000 on that date. So you might say off rip, hey, it's going to be worth $75,000 and I only have to pay $60,000 for it. Why not take advantage? So this could be a good deal. It could also be a bad deal. So that's something to keep in mind. So here it states the residual value after 7 years is going to be 0. First lease court, they routinely acquire equipment for lease to other firms, and the interest rate for these finance agreements is 10%. So with this, we need to ultimately determine, how much is going to be recovered. So this essentially the same fact pattern to what we saw earlier. We start off with the fair market value of the amount to be recovered. We subtract the present value of the exercise price, which is that residual value. And then from there, we factor in the amount that needs to be recovered through the periodic rental payments. And now for the lessee, it's going to be calculated as follows. So we factor in the present value of the periodic lease payments. So now they're paying $92,931, and the present value is $445,211. Then we're going to add the present value of the exercise option, which is the $60,000 multiplied by the present value of $1. And then in such case, the present value of the lease payments is going to be $479,079. And the journal entries are going to be as follows. So as we know, we need to record the exercise of the option. It's similar to recording the periodic lease payments, right? So what that simply means is the portion of the payment is going to cover interest for the entire year, right? And the remaining portion is going to reduce the outstanding liability / receivable balance to 0, as we ultimately see here. Next, we factor in amortization expense. So amortization expense is also going to be affected by the bargain purchase option, right? So as pointed out earlier, sometimes the lessee, normally they'll amortize the right of use asset over the term of the lease. But the issue is that if ownership transfers by contract, or there's an expectation to have the exercise of a purchase option, then in such case, the lessee is more than likely going to amortize over the longer life. And this basically reflects the fact that the lessee anticipates that they're going to use the lease equipment for the full useful life. So if the equipment is worth, $5,000, then in such case, they're using up the entire $5,000 value of the asset. So here we have some penalties. So sometimes things might change. So similar to a lease with a purchase option, if a lease contract includes a penalty payment, this would be when the lessee chooses to terminate the lease or at a time specified in the contract. So termination is something to keep in mind. So if a lease contract includes the payment, then it's choose to terminate the lease at a time specified in the contract, then there's a termination penalty. So additional cash might be required. And if the termination is protected, You'll consider the lease terms to be from the beginning of the lease to the expected termination date. So here we're just looking at a quick example of composition of lease terms and payments. So when the lease terms includes non-cancelable period, lease payments include fixed payments. So this is some good information to go through just to get a better understanding of exactly how this works as it relates to factors included in the lease term and the lease payments used for in accounting for leases. So here we just have a summary of lease uncertainties. So with this illustration, it's going to provide us with a summary of various uncertainties, concerning leasing agreements, because things happen, right? Things definitely happen. So in such case, one of the key things to keep in mind is that sometimes, again, there are things that can be uncertain. So it might influence the way that the lessees and the lessor that they're going to determine the lease payments. It might also have an impact on the right of use asset, the lease liability, and the lender's lease receivable. So these are all things to basically consider. All right, and this is basically just the effects of uncertainties continued. So unguaranteed residual, lease guaranteed residual value. And based on that, that ultimately lets us know how we are going to record the entries. And this is just, again, a continuation of the summary of lease. All right, so now we have some situations where it requires remeasurement of the lease liability. So was there a change in the assessment of? Was there a modification of the terms of the lease? Or there's essentially this flow chart that we can work to get a better understanding. All right, so this is another thing, that sometimes it'll come up in a profession. So is it actually even a lease? So a contract, it meets the definition of a lease when there's two key criteria to be met at the inception of the contract. So there needs to be an identified asset. So the asset, it could be property, it could be plant, it could be equipment, and the asset must be specified in the contract either explicitly or implicitly. Leases, they must have the right, or the lessee rather, must have the right to control the use of the identified asset. The customer can derive substantially all or the potential economic benefits using an asset. The customer can direct the use of the asset throughout the contract term, and the lessor cannot have the right to substantiate an alternative asset anytime during the period of use and potentially benefit economically from being in such a position. All right, so now we have some non-lease component examples. So we have Cascom. They entered into a contract to supply fast franchising with booth servers, and they promised that they're going to monitor the IFRS infrastructure and bought data transfer rates among its various locations. So as a part of the contract, Cascom is going to be required to install the boot service at Fast Corporate Options. And then in such case, they'll be responsible for also the general maintenance and will replace the service with an equivalent model in the event of a breakdown. And then last, we have Fast will provide the necessary interface with the IT infrastructure and will be responsible for decisions related to the configuration and the use of services. So now the question is, well, is this a lease, right? So we have an identified asset, model BS12. The lessee has the right to control and use the identified asset. So in such case, yes, there is a lease. So again, there's 5 criteria, but the key thing is that we want to determine, is it going to be a lease or not? Once we go through those questions, those criteria, those 5 things to ponder on, that ultimately helps to determine whether or not it should be treated as a lease. All right, so we continue on with some non-lease component examples. So another thing we see here is that Cascom rather is going to install various servers at their corporate offices, and Fast is not going to be allowed to have access or direct use of the services. Cascom is tasked with their operation and is going to replace or reconfigure them as needed to provide the services. So there's no identified asset. So this is if it were the asset were the fact pattern were a little different. So as part of the service, will install various servers. And the other example, there was a specific amount or a specific asset rather that was identified to be 12. And it says FAST cannot access or have the direct use of the servers. So then in such case, the lessee does not have right to control the asset. So therefore, no, we don't have a lease. So again, some of the things change ultimately based on the fact pattern. All right. And then now we have the non-lease components of lease payments. So some examples of non-lease components may include service contracts, maintenance, hazard insurance, property taxes. And if the charge packet is going to represent a transfer of goods or services to the lessee, then it's going to qualify as a non-lease component of the payment, and it should be separated from the lease payment. So here it states January 1st, we have Sans Serif Publishers. They leased equipment from First Lease Corp, and First Lease Corp purchased it from CompuDeck at a cost of $479,079. So there's 6 annual payments of $102,000 beginning January 1st. The payments include $2,000, which First Lease Corp is going to use to pay an annual maintenance fee. The interest rate and the financing arrangement is going to be 10%. Finance lease to sans serif, and it's a sales type lease to First Corp. So the first payment is going to be recorded as follows. Well, we know one thing for sure. We promised that we are paying $102,000. The difference is how much of it is going to be allocated to the principal and how much of it is going to be allocated to, in this case, the maintenance expense. And this is the first payment, so that's why we don't have interest expenses yet. And then for the lessor, it's going to be as follows. Cash payment, we debit cash of $102,000. We credit the lease receivable of $100,000 because we received payment. And then we credit maintenance fee payable. And this essentially assumes that the $2,000 maintenance fee hasn't yet been paid to the outside maintenance service. So some other things that need to be considered are indirect or initial, rather, direct costs. So here we see sometimes there's some costs that are associated directly with originating a lease, and they are essential. They're pivotal in order to acquire a lease, and it would not have been incurred had the lease not been incurred. So some initial direct costs include legal fees, drafting things up, commissions, preparing and processing lease documents. And the initial direct costs that are incurred by the lessee, they are added to the right of use asset. So that's much like, let's say, you have a home or you purchase equipment, you also add certain expenses that were incurred to increase your basis. So essentially, similar concept. And for the lessor, accounting for initial direct costs, it ultimately depends on the classification of the lease. So is it a sales type lease? If it's a sales type lease, does it include a selling profit? And if it does, then the initial direct costs are going to be expensed in the period of sale, which is the beginning of the lease. And when we have a sales type lease with no selling profit, then the initial direct costs are going to be deferred and they'll be expensed over the lease term. And if we're dealing with an operating lease, the initial direct costs are deferred and expensed over the lease term. And this is generally done on a straight line basis. Next, we have advance payments. Sometimes certain leases, they call for advance payments to be made at the beginning of the lease. So in such case, these payments, they represent prepaid rent, lease costs, and sometimes the payments, they're going to be included with other payments when the lessee determines what the present value of the lease payments are going to be. All right, just remember the lessor, they don't record a lease receivable for an operating asset. So in such case, these advance payments, they're just going to be treated as deferred rent revenue, and then it'll be allocated normally. Next, we have leasehold improvements, and these represent the cost of improvements made by the lessee to the lease property that reverts back to the lessor at the end of the lease. So in the event that, let's say, the lessee constructs a new building or makes modifications to existing structures, then that cost represents an asset just like any other capital expenditure. So like other assets, the cost is going to be allocated as amortization or depreciation expense over the useful life to the lessee, and it'll be the shorter of the lease term or the physical life of the asset. So these are some key things to keep in mind with these leasehold improvements. Movable assets, as it points out in bullet point 3, not considered leasehold improvements. And leasehold improvements that are made by the lessee, they can affect the determination of the lease term. So something to keep in mind. And we factor in the impact on the statement of cash flow. So for operating leases, lease payments represent rent expense to the lessee. So these amounts are going to be included in net income. So therefore, both the lessee and lessor, they're going to report cash payments for operating leases in a statement of cash flows as flows from operating activities. Next, when we move on to financing leases, the lessee reports the interest position as cash outflow from operating activities, and the principal portion is cash outflow from financing activities. And at the beginning of the lease, the lessee is going to report the right of use asset and lease liability as long as there's non-cash investing / financing activity in the disclosure notes to the financial statements. All right, and this is just statement of cash flows continued. So whenever there's a sales type lease, one of the key things is that you're going to assume that the lessor is effectively selling the product. And from there, it needs to be consistent with reporting sales of products under the installment sales agreement. And in such case, the lessor, they're going to report cash receipts from a sales type lease, and it's going to be considered an inflow from operating activity. So as we know with statement of cash flows, we have operating activities that ultimately is based on a normal day-to-day course operations of a business. Then we have investing. This is essentially the company spending money to purchase property, plant, and equipment, or essentially any asset that's going to last for more than 12 months. And then lastly, we have financing. So this represents the way in which the business, the corporation earns funds, right? So did they, in such case, they issued stock, or they issued bonds and things of that nature, other liabilities, in order to ultimately finance the operations of the business. Next, we have lease disclosures. So sometimes there are requirements, and sometimes they can be, extensive for both the lessee and the lessor. So virtually all aspects of the lease agreement, they need to be disclosed, right? Because again, financial statements, individuals, investors, creditors, banks, they're using these financial statements to make decisions. So in the event that certain things are not disclosed, it potentially has the power to change the decision that someone would have made. Lessees, and lessors, they must provide disclosures that enable users of financial statements to assess the amount, the timing, and the uncertainty of cash flows that arise from the leases. And information disclosed needs to be both qualitative and quantitative. And as it relates to the qualitative disclosures, a general description of the leasing agreement is required. It also needs to include what's the basis for determining the variable lease payments, what's the existence of options to extend or even terminate the lease, and the terms and conditions of residual value guarantees, and any allocation to non-lease payments. Next one is the quantitative. So the quantitative disclosures required for the lessee. There needs to be the present value of operating and finance lease right of use and liabilities, finance lease costs, the operating and short-term lease costs, variable lease costs. So there's a number of things that need to be discussed from a quantitative perspective. All right, so we see there's 2 slides. There's lots of things. There's information about the lease contracts and any significant assumptions and judgments. What's the gross investment and a net investment in sales type and direct. So I'm skipping all of these, not going through them one by one, but the key thing is that when the disclosures are provided, they can't just be, hey, we leased XYZ from First Corp, and that's it. No, there needs to be provided detail in those disclosures. So now we move on to Appendix 15, where there's a sales back. So in a sale-leaseback transaction, the owner of the asset sells it, and then they immediately lease it back from the new owner. So you might be like, wait, what? What's even the point of this? But it's essentially common. So in the sale-leaseback, 2 things happen. First thing is that the lessee is going to receive cash from the sale of the asset, and then the lessee is going to pay periodic rent payments to the buyer, lessor, to retain the use of the asset. So you might be saying, why would someone want to do this? So one of the key things why it's done is that it can generate cash flows through the sale of the asset, and 2, If the asset was financed originally with high interest rate debt and interest rates have fallen, the sale-leaseback transaction in such case, it can be used to effectively refinance at a lower interest rate. And doing so might be cheaper than refinancing through conventional methods. So a lot of things to consider with these sale-leaseback agreements. So here we have a continuation. So we account for this type of agreement in one of two ways. So we can use the sales-leaseback approach, and this is where we record the sale of the asset with any company gains or loss, and then record an operating lease for the leaseback portion in accordance with the lease. So this approach, it is used if the usual requirements for revenue recognition are met. So as we know, what's governed by GAAP, revenue recognition, this is essentially where you can only recognize revenue when it has actually been earned. Sometimes in a profession, individuals, they would pay us in advance. That's considered deferred revenue. It's a liability because we have not earned it yet. And then let's say we receive the income after, then in such case, it would be accounts receivable. All right. So just something to keep in mind. And then with the financing arrangement, if the control of the asset was not passed, then they view the arrangement not as a sale, but as a loan by the lessor to the lessee for the sales price. And the sales-back lease approach is allowed only if the leaseback qualifies as an operating lease. So that's also something to keep in mind. So here we have this example. We have Teledin Distribution Center was in need of cash. Its solution was to sell 4 warehouses for a fair market value of $1 million, and then lease back the warehouses to continue using them. The warehouses, they had a carrying value of $900,000, right? So now it's saying the sales date is December 31st, 2017. There's a non-cancelable lease term. It's 10 years and requires annual payments of $118,360. And the annual lease payments presents $800,000, providing the server with a 10% rate on return. Carrying on with the same example, the sales leaseback. So these are the journal entries that would essentially be recorded. And since none of the criteria for the finance lease is met, in such case, the leaseback is going to be recorded by the lessee as an operating lease, and the sales leaseback then is going to be determined by 2 transactions. One, there's going to be a situation or a transaction rather where there's going to be $100,000 in gain, and then when on the flip side, the lessor is going to record the purchase of the $1 million asset. All right, so a lot to consider when there's sales leaseback example. And then here we just have the journal entries of what's going to be recorded. So we have the interest expense, and again, how do we find it? It's the original cost minus essentially the amount, the fair market value of the lease payments. And here we see we are going to be making payments each year, each quarter, or each year rather, sorry, of $118,360. So we factor in all of these different things to record our journal entries. So this is just an example. So it says the non-cancelable lease term is 4 years, requires annual payments of $147,950, beginning December 31st, 2027. And in such case, so here we see that instead of paying $147,009, or instead of paying $118,360, they're making payments of $147,950. And the annual lease payments have a present value of $1 million instead of $800,000, right? So this is just the example of the sale leaseback and an example of the arrangement. And then these are the journal entries. So we debit cash, credit notes payable. We debit notes payable and then credit cash. And again, though it's structured as a sale and then a lease, in substance, the lessee is actually borrowing $1 million. All right, and then we look at the 28th. That is where we see the interest expense. We debit the notes payable to decrease the balance, and we credit the cash because, again, that is not changing at all. All right, so that brings us to the end of chapter 15, which covers Leases, there's a lot that was covered in this chapter. We learned that leases are classified as either a finance lease or an operating lease. We also learned that there's 5 criteria, and based on whether at least one of those criteria is met, then it will be treated as a finance lease for a lessee. And for lessors, it is considered a sales type lease, and it could be a sales type lease with profit or a sales type lease without profit. All right. So again, this brings us to the end of chapter 15, leases.